right, I'm sure we'll have some more coming in, but we've got a lot of material to get through today and want to make sure we have enough time to do so. So why don't we go ahead and kick this off? For those who aren't able to attend today, we are recording this webinar, and this will be available on Pivotal 180's website and on YouTube within a few days. So don't worry if you miss any of this or any of your colleagues would like to join. We will have that available to them shortly. But with that, want to welcome everybody to today's webinar on project finance modeling for mining and natural resources. My name is Matt Davis. I'm a managing director for Pivotal 180 here in Australia. I'd like to begin by acknowledging the traditional owners of the land on which I and all of you are meeting today, wherever you may be, and pay my respects to our elders past and present. I'm very fortunate to be joined today by two outstanding co-hosts, Rod Hill from Citi and Andrew McLean from Herbert Smith Freehill Kramer. Rod and Andrew are two of the most experienced and knowledgeable professionals in the mining finance sector. They've been really invaluable in helping put together this event today, and I'm very, very fortunate to have them here with me. We'll get into our agenda in just a moment, but first, I wanted to give each of them an opportunity to introduce themselves, and we'll start with Rod. So go ahead, Rod, take it away.
Thanks, Matt. Real pleasure to be here today and to speak with you all on this great topic. Unfortunately, that number of 35 years is actually accurate. I have been doing it that long, and I've had the pleasure of being involved in the mining sector across pretty much all aspects, from the debt side and commodities aspect in particular, with a great deal of focus on project finance, raising money for junior mining companies, as well as covering the much larger entities and where they're typically financed in different capital markets. So pleasure to be here today and to talk about the subject. So I'll hand over to Andrew.
Thanks, Rod. Yeah, likewise, real pleasure to be here today with you both and with everyone on the line. So as Matt said, I'm a partner at Herbert Smith Freehills Kramer. My career turns 21 this year, so I'm thinking about a party, but it feels a bit more like Rod's 35, I've got to say. But I've spent most of those 21 years based in Perth, and as a result, I've sort of been reared on mining project finance, as a lot of people in Perth tend to be connected to the mining sector. So I spent some time overseas and interstate, but most of my career in Perth and doing mining finance, and that is predominantly project finance for commodity projects, whether they're precious metals, base metals, or increasingly in the critical minerals space. We act for lenders and borrowers and enjoy that mix, but also do a lot of sort of corporate and other financing in the mining and other sectors. But that's the key bits. So hand back to you, Matt.
Thanks, Andrew. Thanks, Rod. For myself, as I said, I'm managing director for Pivotal 180 here in Australia. Spent the last 12 or so years in the project finance space across a number of different sectors: renewables, infrastructure, and now mining. Pivotal 180 is a global financial modeling, training, and advisory business. We run training, provide training and mentoring to lenders and investors around the world in project finance modeling for energy, infrastructure, resources, mining, and a number of other sectors. Hopefully, a lot of things to talk about today, but hopefully you'll learn a bit from today's session. And if you do and you enjoy this program, would love to hear from you about what you enjoyed, what else you'd like to learn. And if you'd be interested in learning more about financial modeling training programs for your organization, please reach out after the webinar. So a couple of things we're going to talk about over the next 90 minutes together. We're going to start by sort of talking about what project finance is in general, what the nature of project finance is. And when we're talking about raising capital, raising debt in particular for energy and natural resources deals, what that looks like. And then myself and Rod and Andrew together will talk about some things that maybe are a little bit different when it comes to the mining sector because of the specific risks involved in mining that make it a little bit more challenging and less vanilla, say, than many other industries to which this sort of structure is often applied. We'll talk about what lenders require in models, what they require in contracts and in deals, and their expectations for what to see in a best practice financial model for executing a mining transaction. And then Andrew will be able to speak quite well to commercial and legal considerations that impact deal structuring. How do we tie the model to the contracts and the contracts to the model and make sure those are aligned? Because if your model doesn't match your contracts, well, it's not worth very much then. Hopefully at the end, we should have a little bit of time for Q&A. If you have any questions as we're going, there's a couple different ways you can do that. There is a Q&A, question and answer option. You can submit questions through that. If they're relevant as we're going through, we may answer them as we go. Otherwise, we'll sort of come to them at the end. If you prefer, you're welcome to post your questions in the webinar chat as well. We'll get to as many of those as we can towards the end. And if we do run out of time, please do follow up via email, and we're happy to provide some more thoughts that way. So with that, let's start off with what project finance is in general. Before thinking about mining or any other industry, what are we talking about when I talk about project finance, when I talk about, in particular, a way that not all, but a lot of projects are financed, which is with what we call non-recourse financing. And this is a way that I start a lot of our training courses at Pivotal 180 is with a sort of question around how in the world could you ever convince a lender, a sophisticated financial institution, to lend millions, hundreds of millions, maybe even billions of dollars, depending on the size of the project, to a project company that is set up to own a project, right? It doesn't own anything else. It owns just the contracts of that project. It has no credit rating of its own. It maybe has no employees. It has no operating history. And really critically, it's making no guarantee to repay. It's hoping to raise debt financing on the basis of what we call non-recourse financing. Yes, these slides, not the slides, but the presentation will be available, sorry, after the webinar, on the basis of simply the cash flows of the project. The only guarantee to repay will be if the project generates, or the only way that the loan will be repaid, rather, will be if the project company, through the project, generates enough cash flow to do so. And that seems sort of like a crazy thing to do, right? To be lending that much money on a non-recourse, no guarantee to repay. Example we often give is that even if the equity owner of the project is Bill Gates or the King of England, they still can't say if the project doesn't generate enough cash flow, hey, Bill, you've got to pay me back. Only the project company has liability to repay. And because of this, it places extra emphasis and extra importance on accurate and precise cash flow modeling and flexible cash flow modeling, as we'll come to as well. And that means that we need a good financial model. We need a model that can take into account all of the different ways that the various parties involved in the deal, from the EPC contractor who builds it, to the fuel supplier, whoever is operating the project, the off-taker, if we're talking about an energy project, and we'll talk about how that might be a little different from mining, how all of these parties interact with the deal and the financial impact of each of them. Now, a lot of different industries and types of infrastructure that are funded on this basis, like power plants, like toll roads, like hospitals, lots of different things are funded in this way. They have in common that they often are fairly low risk, right? That maybe they're fairly low risk in terms of the cost to build, fixed cost perhaps with penalties to the EPC if it's not built on time, fixed price. That the operating costs are generally fairly well known with short to midterm contracts at fixed prices and maybe some escalators, but pretty well known and predictable. That sales volumes like sales of energy or number of cars going over a road might be predictable, and that if they're not, right, maybe instead revenue might be earned via fixed rates, fixed project agreements that governments might provide. And that the price that's going to be received for what these projects are selling is predictable as well. Maybe a long-term energy sales contract, or again, one of those project agreements, simply an agreement with a government or government entity to provide a fixed amount of revenue just in exchange for operating the infrastructure. That's great, right? When we're lending just against cash flows, this is a great thing to have, is predictability. Lenders then can rely on that predictability, know that yes, things might vary a little bit from what the model, as we'll get to, expects, but hopefully not too much. Hopefully, with that combination of things, they can look at a model and look at a forecast of course, some upfront construction costs to build the project, but hopefully fairly steady revenues over time, hopefully fairly steady operating costs over time, therefore hopefully fairly steady cash flows, as we'll come to in a minute. Lenders love to see this predictability in cash flows, predictability in revenues and costs, make it fairly easy for, say, a solar project or a toll road or a hospital, hopefully, to be able to be financed on this basis. And certainly these things can get more complicated, but when we have predictable cash flows, we can size debt and structure debt fairly simply when it comes to project finance. Now, that might not always be the case when it comes to mining, as we'll get to in a minute, but let's start with that idea. If we have predictable, forecastable, highly forecastable cash flows, then how would we size and structure debt for project finance? And then how might we tweak it when we come to something a little bit less predictable, like a mining project? Now, to start with, for sizing debt for project finance in this way, we really care about three things when it comes to sizing debt. And in general, we want to raise as much debt as we can a lot of the time because, as many of you would know, why do we raise debt? We raise debt because with gearing or leverage or whatever term you want to give it, equity investors achieve better returns by raising debt, by having higher gearing. And in traditional project finance, and still in mining to an extent, how much gearing or how much debt a project can raise really depends on three things. It depends on cash available for debt service, or CFADs as it's often called. It depends on how much debt service is going to be paid. And then it depends on a third thing called the debt service coverage ratio, a really critical ratio when it comes to sizing and structuring debt for project finance and infrastructure transactions. So I want to talk about what each of these are very briefly, and then how they're combined to figure out how much debt a project might be able to raise. And then Rod will sort of throw that all into the ocean and say, hey, but actually for mining, we got to make things a little bit more complicated. So we'll start with CFADs, and then cash flow is going to matter for any infrastructure. By the way, cash flow forecast going to matter for mining, so maybe not entirely going to throw this all overboard eventually. When we talk about CFADs, some people think this is really simple, but we got to be quite precise about this. We're not talking about, say, EBITDA, right? EBITDA is an accounting metric that accountants make up to often sort of remove things that they don't want to include. You have EBITDA R, EBITDA X, all sorts of things they might exclude. When I talk about cash flow, we talk about cash flow for a project that's going to be financed on this basis. What we truly care about is how much cash flow is available after paying all things that need to be paid first that can be then paid to the lenders. Depending on where you are, that may or may not include deducting taxes. Really depends on whether or not your project company is a pass-through entity or not, and that varies around the world. But we're truly just talking very simply how much cash flow is available at the project company level that might be able to be paid to the lenders. So not net income, not EBITDA. What are my revenues? What are all my costs? How much cash am I truly generating each period? That's the first piece. Second piece of the puzzle I mentioned is debt service. How much cash flow am I going to have? How much debt service can I pay with it? And there's really two parts to debt service, and then they're impacted by a third thing. There's interest, right? Interest you have to pay on money you've borrowed. And then there's principal amortization. How much do I need to repay to my lender each period? When I say debt service, I'm simply talking about the combination of those two, interest and principal. And in a really simple example, if I had, say, a 5-year loan for $100 that was going to have a 5% interest rate, good luck with that, and then 5-year straight line principal amortization, would look something like this, right? We have, say, in year one, $5 of interest, just 5% of the opening balance of 100. And with 20-year straight line amortization, and not a structure we use often as we'll come to, but let's start with that for now. That would be $20 a year, $20 in year one of principal amortization. So $25 of debt service total in year one. That would mean I'd have $80 of debt left over at the end of year one and 80 at the start of year two. In year two, I'd pay a little less interest because I owe a little less, have a little lower balance, 5% of 80 now, still the same principal, and $24 of total debt service in year two. And we could just repeat this year after year. Calculate interest on the opening balance of the loan, calculate principal based off whatever the repayment schedule is. In this case, a simple $20 a year. Total of interest and principal is my debt service. Talked about cash flow, talked about debt service. The third piece I said, really going to be critically important, is something called the DSCR, or debt service coverage ratio. All a DSCR is the ratio, as the name suggests, of our cash flow to our debt service, just our CFADs divided by our debt service. So if we had the same debt service as I had on the previous slide, and then just say made up CFADs of $60 a year, in year one, my DSCR would be 60 divided by 25, 2.4 times. Year two, 60 divided by 24, 2.5 times, and so on. And this is a number that's included in all sorts of financial models, a ratio that's in pretty much any project finance model and financial model you'll ever see. But it's not one that people maybe spend a lot of time thinking about why. Why do we care about this? Why do we care about this in particular when it comes to non-recourse project finance debt? If you think about this, right, what does 2.4 mean, right? It means that in year one, for example, this project could pay, if it was going to generate $60 of CFADs, could pay its debt service 2.4 times over, right? If it was only 1.4, it can only pay it 1.4 times over. If it was 2, it could pay it twice. And when you think about it that way, it becomes sort of clearer that this is really a measure of the health of cash flows relative to debt service, right? If I had a DSCR of 1, it would mean, or if I forecast a DSCR of 1 rather, it would mean the project was expected to generate just enough cash flow to pay the lenders. And if things got even $1 worse than expected, they wouldn't have enough, right? Not the kind of situation you want to be in. It does happen sometimes. I'm sure folks who have been around the mining industry a long time have seen it happen many times. But it's really a measure of the buffer or the safety. How much extra cash flow does the project have? How many times could it pay its debt service? It's a measure of the cash flow's health. And what we'll actually see in just a moment is that in many sectors, including in mining to some extent, lenders will set what's called a minimum DSCR, and they'll choose that DSCR based on their view of the risk of the cash flows. Instead of just it being an output here of, hey, how much cash flow is there and how much debt service is there, they'll say, you know what? Based on how much risk we see in your forecast of cash flows, we will assign a minimum DSCR, and then you need to make sure in sizing and structuring your debt that you will maintain at least that debt service coverage ratio in every single period. And in that way, they say, hey, the more risk I see, the higher DSCR I'm going to require, the more buffer, the more safety I need. And the less risk I see in the cash flows, the more certainty I have in the cash flows, the lower DSCR I'll allow. I'll allow a smaller buffer there because I don't think things could get too bad. Now, there's other ways they can protect themselves as well, which we'll come to, but that's sort of our starting point here. So cash flow, interest or debt service rather, and then DSCR. If we put those all together, we'll eventually, in just a minute, see how we typically size and structure debt for these deals. But the last bit of how we get there is we got to figure out how we're going to repay a loan, right? And there's lots of different ways to repay loans. I'm going to talk about a couple of them, and including a couple that we don't see very often when it comes to project finance. And then we'll talk about one that we do see quite often in mining and a number of other sectors that are financed in this way. Maybe the simplest way to repay a loan would be with, say, a mortgage structure, the kind of loan you see when you borrow money to buy a house, right? This is where when we make our payments, they're basically obviously adjusting for rates, but otherwise the same every single month, say. We have the same amount of total debt service every single month, every single year, however often we're talking, right? As we pay down the loan, our principal component of each payment is a little bit more than the previous one because we owe a little bit less interest than we owed on the prior period because we've paid down the loan further. Total debt service the same every period. Principal component increases as the interest component decreases to get to that same total number. That means we pay off principal a lot faster towards the end. If we looked at the loan balance over time, it would decline much faster towards the later end of the loan than the early years. That's one option for repaying a loan, though as we'll see in a minute, not typically one we use very often when it comes to project finance. Another structure that we might see, the example I gave a couple slides ago, is straight line amortization. That's where we would simply pay the same amount of principal each period instead of fixed debt service, fixed principal component of debt service each period. Still seeing the interest go down over time because we just calculate our interest based on the opening balance of the loan and we're still paying off our loan here. But that means that our total debt service is actually declining over time, right? As we get further into the future, principal stays the same, interest declines, total debt service declines as well. Nice part of this structure, it's really easy to know how much of a loan will be outstanding at any given time in the future. Halfway through the loan, half of it will be left, 80% of the way through the loan life, 20% will be left. But neither of these structures really works very well when it comes to project finance and non-recourse financing. And that's because they both sort of make up a repayment structure and repayment profile that has nothing to do with the expected future cash flows of the project. And if the only entity making a guarantee to repay a loan is the project company itself, the one who's borrowing, then from a lender's standpoint, you'd probably like to see that future debt service is sort of shaped or sculpted, as we often say in the industry, in the same sort of way that the cash flows are expected to look. And there's all sorts of reasons that typical mining project, solar farm, airport, toll road, whatever it is, would not be likely to have cash flows that are either flat, like a mortgage style repayment structure would indicate, or downward trending, like this structure might indicate. For example, seasonality, right? All sorts of businesses, all sorts of projects have seasonality, whether it's an energy project, a toll road, a hospital, an airport. They're going to generate different amounts of cash flow, are going to be expected to, different times of year, different quarters of the year, say. Debt service is often made quarterly. If we expect cash flows to go up and down each quarter and we're going to have to pay debt service each quarter, well, it doesn't really make sense to be paying the same amount of debt service each quarter or to have a slowly declining amount of debt service paid each quarter over time. Maybe regular maintenance, right? Lots of different infrastructure might have some major maintenance project need to be shut down for maintenance or have some major piece of equipment replaced every so often. That might create unevenness in cash flows. And again, wouldn't want to have static debt service or downward trending debt service in that case either. Maybe we have inflation, right? We might expect a project to generate a little bit more cash flow over time as it can charge higher rates for what it's selling or any number of other things. Certainly wouldn't want to have downward trending debt service with a straight line amortization profile if that was what we expected of our cash flows. And probably a flat mortgage style structure doesn't work very well either, because getting back to that idea of the DSCR, if this is overlaying all of those sort of things on an annual basis, so not even looking at seasonality here, might end up with a project that on an annual basis has, say, generally upward trending cash flows, right? Imagine we expect to be able to sell our product for a little bit more over time. But every so often, some major maintenance, something has to be fixed or replaced or the mine shut down or whatever it is. And that's going to reduce cash flows a little bit, right? If we tried to structure debt with a mortgage style flat repayment structure, and we had to meet that lender minimum DSCR requirement that I talked about a little while ago and say, hey, in no year or no period can the DSCR fall below that minimum DSCR, this gray area here now is debt service, principal plus interest. I would end up being bound by my lowest cash flow period, right? I'd say, well, I've got to make the same amount of debt service every single period because I've got this mortgage style structure. And I can never go below, say, making this up now, a 1.3 times DSCR. Well, then whatever period is my least amount of cash flow, I can make the amount of debt service in that year that gets me to a 1.3. I've got to make the same debt service in every other year because of that structure. And that means every other year I'm going to have a much bigger DSCR. Lender's going to be okay with that, right? A lender's not angry about the DSCR being more than their minimum. But as a borrower, what we're doing here is we're giving up debt. We're saying, I'm not borrowing as much as I could be because I'm not promising the maximum amount of my cash flow to my lender in the future. And I want to borrow as much as I can. So hopefully it's going to improve my returns. So because of that, we see this mortgage style structure doesn't really work very well for raising the maximum amount of debt. And to go one step further, it's even worse when it comes to straight line, right? It's still going to be bound by probably our minimum cash flow period. But now this excess cash flow, this slack, for lack of a better term, that I'm not using for debt service is even wider than it was before. Giving up the ability to raise debt, not what I want to do as a borrower. I want to find a way to borrow the maximum amount while maintaining that lender's requirement of that minimum DSCR. And so to do that, what we see most often in project finance, and this does apply to mining, but with some more nuance as we'll get to, is something called sculpted debt repayment, where we take a ratio, maybe the DSCR, maybe another one, that a lender has given to us based on the risk that they've assessed of the project cash flows, and we divide our forecast cash flows in the model by that DSCR in every single period, and that determines for us how much debt service we'll be able to make in that period. Therefore, if our cash flows are higher, we'll make more debt service, and if our cash flows are lower, we'll pay less debt service. And if you just look at the amount of gray area here versus, say, here, it's clear that we're seeing a lot more debt service with this sculpted structure. And from a really basic standpoint, hey, the more I'll promise to pay you in the future, the more you'll be willing to lend to me today. So if I want to maximize my borrowing as an equity sponsor, as a borrower, owner of projects, I want to use this sort of sculpted ratio-based debt sizing approach to maximize how much I can borrow while also having the lender be happy with the fact that I'll maintain this minimum ratio. I can run you through the math here, but the basic idea is that if we know that our DSCR is equal to our CFADs divided by our debt service, our principal plus interest, we can move terms around again, take you back to maybe some year 8 algebra a little bit, hopefully not too bad of flashbacks for anybody here, just moving the terms around. And what we eventually get to is that the amount of principal I can pay, which over the life of the loan, right, would represent how much I can borrow in the first place. Rod could tell you the lenders definitely like to get their principal repaid. It's one of the main things they look for. Will be equal to my CFADs over the life of the loan divided by whatever that DSCR is the lender's given me, less all the interest I've got to pay, right? And from that, we can sort of know that, well, first of all, debt size, without getting into the The nitty-gritty math of it is just going to be the present value of my future debt service, where that debt service is just my CFADs divided by my DSCR, present value at the interest rate. And the things that will impact my debt size at a base level are going to be how much CFADs I have, right? And that includes both what the project's going to do when it operates, as well as how long a tenor I'll be able to borrow and therefore repay for. What my DSCR is, the higher the DSCR, the less I'll be able to borrow. And my interest rate, the more interest I've got to pay, the less cash I'll have to be able to pay principal, therefore the less I can borrow, right? That's the really, really simple way to think about it. But things are about to get a bit more complicated because when it comes to mining, there's a number of other things we might have to think about because of the nature of mining in particular and how it presents maybe more or different risks than a lot of other sectors that might be financed in this way. So what's a little different for mining? I started with this chart, right? I said, hey, we've got a project that's going to be funded on a non-recourse basis, raising money from a lender, going to have an EPC build the project, engineering, procurement, and construction, maybe a fuel supplier, depends on our type of project. Some people operating the project, hopefully contracts to sell power. Hopefully some of these things or many of these things, if not all of them, we know the values of or we've got a very forecastable in nature, right? When it comes to mining, things get a little bit less predictable, right? First of all, EPCs, depending on the project, might be less likely to give a fixed rate, right? They might have some sort of cost plus structure, might have many EPCs with one EPCM, EPC management company, might have more operating costs than and more variable operating costs than a lot of other sectors. We need vehicles, we need fuel, we need processing. Some of these things might be very difficult to predict the cost of, or may even have, again, as we'll get to in a moment, sort of cost plus structure. And then the revenues we're going to be earning and the cash flows we'll be generating could be really challenging to forecast as well. Instead of selling, say, energy under a fixed price contract or receiving toll revenues or even just a fixed revenue from a government for operating, say, a hospital, when it comes to mining, we're selling product. We may be selling that product that we've mined at spot prices that could vary tremendously over time, even throughout the year and then from year to year as well. Maybe we can hedge some of that, but maybe not all of it. Looking at this one other way, right? We're just talking about a lot of unknowns. We don't know for sure. We can forecast, and we do a lot of work on this. We may not know the quantity of material we can recover from underground or what the quality of that material is going to be. We might not know, at least not with as much predictability, what the cost to recover that material will be and the cost to process that material. We certainly can forecast, but don't really know for sure what the future market prices of the material that we're going to be mining is going to be. As many of you know, mines often located in really hard to reach regions. That might make operating the project more costly than operating something else, might make building the project more costly or riskier in terms of cost to build. And overall, there's just high variability of a lot of different things when it comes to mines, the EPC cost, the build cost, vehicle cost, fuel cost, processing cost, overall revenues when we don't know our volume, our quality, our price. When we compare it to other PF, just a lot more variability. And because of that, some risks might be able to be hedged, right? Can hedge sale prices. Rod will talk a little bit about that. Others, maybe we can only forecast, and we need to understand how much will it impact us if we're wrong, and how wrong might we be. I said at the very beginning or early on, we think about traditional infrastructure like a power plant or a toll road financed with PF. Predictable stuff, right? Mining, a little different. Our build costs, much higher risk. Could be a cost plus contract, or maybe a maximum cost sort of structure. Penalties and bonuses that might apply depending on timing. Operating costs could be quite volatile, especially when it comes to fuel, and fuel, especially getting it to hard to reach places, may have short-term contracts, cost plus pricing for things like processing. Sales volumes, difficult to forecast. Unknown quantity and quality, as I said, unknown recovery costs. And when I say unknown, I don't mean no way to forecast. I just mean less certainty than we might have in other industries. And as Rod will talk about, really importantly, limited life resource, right? We can't just keep operating. Eventually, we're going to run out of material. Our sales prices could be quite volatile, could be uncertain. We have forecasts, but they might be unreliable. Maybe we can have some short-term forwards or hedges to help us mitigate that, but maybe we don't want to do that too much and give up too much upside. So compared to this traditional PF funded infrastructure, just a lot more uncertainty, a lot more that could go wrong and a lot more ways that our forecast of cash flow might differ from what actually happens in the future. What does that mean? Well, Rod will get into this in a lot more detail in just a moment, but from a lender standpoint, they say, hey, more risk, I got to be a little bit more careful, right? Lenders are going to be conservative with their view of CFADs, probably not just going to take equity's view for it, although if you can get that, that's great, but probably going to be a little more conservative there. Going to be conservative on the tenor of the loan. Instead of a 15 or a 20 or a 25-year loan tenor, something quite a bit shorter. Higher DSCRs and also additional ratios to consider, and those are going to be higher relative to some other industries. And they might look to get repaid a little bit faster or to share in some of the upside of the project if the project generates excess cash flows, to be able to share in some of that. From an equity investor standpoint, well, that taking more risk as well, probably going to require a higher return. Overall, just the general risks and characteristics of mining projects when compared to other PF infrastructure just requires more nuance, both in models and in contracts. And probably nobody better to talk about that some more than Rod. So I'll hand it over to Rod.
Thanks, Matt. Hopefully everybody can hear me okay. Just before I move into the next section, I might just address a question that's been raised in the chat, because I think it's a really critical question. And that is, what's the difference between CFADs and operating cash flows? CFADs, by its definition, is the cash flow available before debt service. So it's really all the revenues and expenses that have to be covered before debt service can be addressed. Now, some expenditures are discretionary. One might argue that exploration costs, if they're really step out type expenditures, could be discretionary. So they could go below the line. Paying for royalties, paying taxes, although Matt mentioned a scenario in different jurisdictions where that may not be the case, these have to be paid before debt service. So that's really the key element here. What has to be paid to ensure the business can continue and generate free cash that's available for debt service? Operating cash flow is perhaps more of an accounting term, as you would separate operating cash flows from investing cash flows and financing cash flows. And so there's certain elements within this that would not be captured. The other key thing with CFADs, and Matt mentioned this, it is a true cash flow measure. So if there's a working capital adjustment in the business, that has to be taken into account. You can't take accounting revenues and say that's fine. You have to think about what the working capital adjustments may be. And depending on the nature of the asset, a gold project where perhaps you're receiving revenue within 7 days may not be maybe that relevant. In other cases, if there's a long period for getting paid for your product or for adjustments for expenditures, then certainly that has to be taken into account. So hopefully that addresses the question that was raised. As we move into mining finance debt sizing, and I have to apologize a little bit to our oil and gas attendees, because I am more rooted in mining. So I'll probably refer to that. The reality is what we're talking about here really does apply quite equally across oil and gas and mining projects, because one of the key things about them is they have limited resource lives. This is a key determinant in the debt sizing process. If an asset has a relatively restricted life, that has to be taken into account. In some commodities, especially bulk commodities, iron ore, coal, certainly oil and gas projects to some extent, the reserve life may be so long that actually other constraints come into effect, like what is the appetite of lenders for tenor rather than the reserve itself. Another key aspect with mining projects is the higher variability of cash flows. Matt mentioned situations of seasonality in energy projects, perhaps, or power projects. But in mining, it comes down to the resource and the reserve. What is the grade profile throughout the life of the asset? What is the capital expenditure profile? These can add quite meaningful changes to the cash flow available in any one period. And importantly, they can change again just because you have seasonality in an industry, that's probably going to be the same throughout the life. But if you have something like a mining project where the life of mine plan is refreshed every year or so, that can materially change the cash flows, and that has to be taken into account. And the final point that makes debt sizing sometimes a challenge for mining projects and natural resources is that the drivers of the financial model typically come from underlying very complex models. They may be geostatistical models, they may be mine plans that lenders don't necessarily have access to, and so a complete sensitivity can't be undertaken, and we'll come on to that. So the first point to really constrain the loan life is around the reserve. Now, most of these comments are going to be related to lenders, bank lenders, and the way bank lenders think. It's worth also bearing in mind, though, that different debt capital providers, private credit, the 144A high yield market, and so forth, can look at this slightly differently. And that can create opportunities for borrowers in terms of the markets they access. And obviously, from a Citi perspective, that's something we're strong across the whole piece, and to look at the pros and cons of different markets. But for this analysis, let's talk predominantly about the bank lending market. Bank lenders will look at reserves. And what we summarize here for mining projects, and again, the oil and gas analogy of P1, P2 is similar, but we have mineral resources which has a geological level of confidence and a prospect of economic viability, but further work's required to convert those indicated and measured resources into reserves that have then the economic confidence, and that is what lenders will look to. This is particularly relevant for startup projects, projects which have a historical track record. They have a track record of resource to reserve conversion, can mean that there is more comfort around taking that risk. But typically, banking resources is more of an equity risk. Just to address the question, resources looks at the geological confidence. It comes from the mining models, and it comes from the geostats. Again, there has to be a prospect of profit. So there is a modifying factor, which is a commodity price applied. But typically, resources only gives you a degree of geological confidence. To convert from resource to reserve, you need these modifying factors, which would be the commodity price, a view of the costs, a view of the capital costs, and that all goes into the model to arrive at what a reserve is. And this comes down to a competent person under the JORC code determining what is a resource and what is a reserve. So to recap, lenders will look at reserves. Now, importantly, lenders will not want to get repaid from the last ounce of reserve, I should say. It's easy to make mistakes on this topic, or the last ton of the reserve. So we look at a reserve tail ratio, which is at the outset of the project, we will look at what is the forecast remaining reserves when the loan is repaid to the total initial reserves. And lenders will typically want to see this buffer as being somewhere in the range of 25 to 30%. As I mentioned, for projects which have an operating track record, there can be a little bit of flexibility on this. And again, this analysis works very well, not just for startup projects, but also acquisition financing, for example, where a company may be acquiring an asset and for whatever reason, it doesn't want to guarantee it. It wants it's financed on a standalone basis. Also very relevant for joint venture situations for a similar reason. So what we then do is we say, well, based on this reserve and based on the reserve tail that's appropriate for this project, the loan needs to be repaid within that period of time. And therefore, we have that tail of protection before the loan is fully repaid. So this is a starting point for the debt sizing process. It establishes a maximum loan life that we can then work to finalize what the debt size can be. So once we have this, we can then move on to some cash flow numbers. And so the best tool for this is the loan life cover ratio. The loan life cover ratio looks at the NPV of the CFADs over the loan life, and it divides that by the debt outstanding. So ignoring the profile, the sculpting of repayments, it basically says, am I going to generate enough cash flow on a discounted basis to repay the loan? And will I have enough buffer for that? And what we often do is we start with a rule of thumb level, and it will depend on the asset and the nature of the geology, nature of the commodity. But we might say, well, as a starting point, we'll start at 1.75 times. And we can say, therefore, that we take the CFADs, we divide it by the 1.75, and it comes up with a starting loan amount before we start getting into the sculpting process. The sculpting process comes next. And the tools, um, I, sorry, some additional points here on the debt size. The one thing we also look at is the project life cover ratio. Now, the project life cover ratio is essentially the same as the loan life, except it looks over the full reserve life rather than just the loan life. The point of looking at the project life ratio is to ensure that there's enough economic value in that reserve tail we mentioned to create a cash buffer. It's fine having the commodity in the ground, but if the cash flows are such that the reserve may be there, but there's extra cost to remove it, such that the cash flow is much lower in the back end of the project, then that tail doesn't necessarily give you much comfort anyway. So what's important there is to use the project life ratio to give comfort to the size. And we would typically use a higher ratio there because, of course, we have an extra 25 or 30% of mine life to look to. The final constraining factor is gearing. Lenders will want to see some skin in the game. They'll want to see some equity contribution to the project. Again, this will depend on the nature of the project. Companies will often say, yes, but I've spent all this money on my feasibility study, or I've spent all my money on this or other aspects. But typically lenders will say no. When it comes to this point in time, which is the feasibility study phase, as we move into the construction period, we want to see some additional equity, and that percentage will change on the asset. Questions arisen relating to the discount rate for these ratios. Typically, we'll use the cost of debt as opposed to a weighted average cost of capital.
Yeah, just to jump in there, Rod. So it obviously it's a bit of a more complicated bit of maths in that we're not looking at a simple, probably static interest rate, but rather one that's changing over time, some sort of base rate plus a margin. So that's one thing the model will need to be able to do is be able to do it to discount future cash flows based on a changing interest rate, which is a very common and really important part of any debt sizing model.
Yeah, that's right. That's right. So once we've arrived at our debt size, we can start thinking about sculpting. And as Matt said, the debt service cover ratio is our principal tool for this. Now, this is where mining again becomes quite challenging because we may have these very different cash flow amounts per period, be that quarter or month or semi-annual, that needs to be taken into account. On the one hand, it's nice when you have more certain cash flows to be able to do the type of profile that Matt showed, where you essentially have a consistent ratio throughout and a consistent buffer, because that will ensure that you maximize the debt size. But the problem with mining sometimes is that you may have these different periods, and different periods could get updated in future iterations of the life of mine plan. And so on the one hand, you want a smooth ratio, but you also need to be careful that you're not creating wild swings in what the principal amounts may be in any one period to address that if it suddenly changes. Banks like to be paid on time, and they also don't like to completely resculpt the loan profile every 6 months because there's a new plan. So there's a balancing act here between aiming for a smooth ratio, but having a profile which is not too variable. And so it's more of an art than science. And of course, what we're trying to do here is maximize the debt size and ensure that this part of the process doesn't take away from what may be seen as a more theoretical maximum that would come from the loan life and project life ratios. Now, it's also important to remember that these rules of thumb are only a starting point, and we'll come on to sensitivity analysis in a moment. But there are other elements that can be used to enhance the debt capacity. Commodity hedging is one. We'll mention that in a moment. And then there's the idea of cash sweeping and cash sharing. Cash sweeping, and there's different definitions, and these are not legal definitions, as Andrew will attest. They change depending on the negotiations. But in simple terms, I look at cash sweep as being each period there is an X percentage of free cash that's available after debt service as opposed to before debt service to apply to debt reduction. That may be done, as we often say, in reverse order of maturity. What that essentially is doing is reducing the loan life by repaying debt earlier. It can also be pro rata. It can be applied by reducing each individual principal installment. Very rare in mining, but it can be done, and it actually can be useful, especially for commodities which have more volatile profiles. Cash share is more of a exactly what it says. If you make distributions, I'm going to take a dollar for dollar or whatever the ratio may be. The idea being lenders are happy for the cash to stay in the business, be put back in the ground. But if it's being sent out of the business and outside of the obligor group, the security pool, then we'd rather have some of it first. So we move on to sensitivity analysis. Um, if the profile sculpting is all more art than science, this is similar as well. We have to look at the technical factors. We have to look at the economic factors. Clearly, commodity prices are key here in terms of driving outcomes. Being clear that we're comfortable with the commodity prices. That may be using external providers, AME, for example, or it may be using a bank's own internal sources, or it may be using equity, but very rarely will lenders be comfortable using equity consensus. It will be discounted from that. But then having a view as to, okay, that's my base case commodity profile. What sensitivity am I going to use? Is 10% fair? I mean, it's a blunt tool. Is it okay? What information have I got to look to? The technical sensitivities really come around as a result of input from independent technical consultants, or if you have your own in-house technical people to do that, they can do that. Related to the internal technical review or external technical review is the base case acceptable? Am I happy with the base case that the client's provided, or is it something that has to be adjusted? Do I feel I need a little bit of extra capex for certain projects, or can it be accepted? And this is all part of the process. Now, when it comes to applying sensitivities, anybody can break a model. You can put a 50% decrease in on a grade, and yes, you might run out of cash, but is that sensible? And so it's really that challenge of finding the sensitivities that banks are happy with. Typically, it's the front office bankers arguing with their credit departments over what's appropriate and ensuring that you come up with a sensible outcome. One of the key things as we go through a sensitivity analysis is also understanding what can change. Mining projects and oil and gas projects, they're dynamic beasts. If a sensitivity were to change, if a commodity price were to change, what can the company do? What levers can it pull to change how they operate the business? And so, again, natural resource bankers who have had experience in this can apply that level of common sense and sensitivity rather than approaching this as a blunt instrument. And so, going through this process will confirm or deny whether or not the rules of thumb sensitivity metrics or debt sizing metrics we used initially are appropriate or whether they have to be adjusted. Another great tool for this is break-even analysis. How far does a grade need to change before some definition of break-even is achieved? The one I've always typically liked is a loan life cover ratio of 1x. At what point does the company have insufficient cash to repay the loan if you ignore things like profile, the sculpting, just cash sweep it? How far can you push a metric before you hit that point? But others exist, debt service cover ratios, project life ratios. So examples of the type of sensitivities that can be applied are shown here, which really can either be more single variable sensitivities, or they can be multivariable, where a number of sensitivities that are applied together. And again, once the outcome of this is determined, we can see whether or not we have to change our base case size, or whether we can get comfortable with some of these sensitivities because we feel comfortable the company has the levers to pull to address itself going forward. The final topic that I'm going to touch on very, very briefly is hedging. We could do a complete session on hedging, so I'm going to leave this at one slide. And really, the point here is that commodity hedging is not necessarily favored by equity. They like to be exposed to the upside in commodity prices, but they also don't necessarily want equity dilution. So they want to maximize the debt. So there's always a trade-off between the two sides. And hedging, if done prudently, can actually increase or decrease debt capacity. And this really comes down to whether the commodity and the forward curve is in contango or backwardation. With gold, we typically have an upward sloping forward curve, a contango curve. This is a function of lease rates versus interest rates, which means a forward price can be higher than today. So based on that, that can help increase the debt capacity. Obviously, removing volatility will increase debt capacity because the sensitivity will be less. But if a forward curve is in backwardation such that forward prices are lower than today, then whilst it still creates the benefit of reduced commodity price volatility, it may actually be counterproductive because the forward prices are lower. And this is especially relevant in a base metal greenfield project where most of the nice prices in the forward curve are actually during the construction period when you're not actually generating revenue. And once the project kicks in, all of a sudden you're into a lower price environment through the curve. So this needs to be taken into account. The final point on hedging is that lenders will always be focused on the risk that a project becomes overcommitted. Does it enter into hedging products like forwards, swaps, sold call options, which actually create commitments? Because it's important that the volume of resource and reserve the company has is sufficient for its hedging commitments and it doesn't become overcommitted. As a result of that, it's important that the model can generate these ratios and have them displayed so that the lenders and the company can feel comfortable that under sensitivity analysis, again, like a grade sensitivity, for example, there isn't exposure to a risk of overcommitment. So with that, I'll finish up on this point and move to Andrew to talk about some of the legal aspects.
Thanks. Thanks, Rod. There is a question though that maybe we can answer together, that's come up on the Q&A, and that's how can lenders judge on revenue lines of the project when the output from the project does not have a hedging tool, for example, LME and base metal or prevailing market index? And maybe I'll have a go as the lawyer and you can correct me as the banker.
Sure.
But I mean, it's a really interesting question and has been really topical. We mentioned at the start, we've sort of been increasingly working on critical minerals projects in the last few years, and it's a live issue in modeling for projects in that space. So lithium, rare earths, and products like that. What we're seeing there is reliance on market experts. So there's sort of organisations that produce marketing reports that will include a forecast price. The issue often being that if you look from one to the next, there might be quite a bit of variability in the forward curves that they're putting out. So what we've actually seen lenders use in that circumstance is actually taking more than one and averaging it out to deal with the fact that it is less certain and there are varying views on where the market is going to go. And equally, if one of the experts that are being relied on is wildly out of sort of sync with the rest of the marketing data that's being provided, that potentially you can exclude sort of that as an anomalous reference point. So, Rod, how did I go? You might want to add to that.
Yeah, no, look, I think that's absolutely right. And again, I think this is why we've seen some projects in critical minerals, lithium, and some of these other commodities, finding it very difficult to get banked in the traditional bank lending market because we've seen so much volatility in these commodities that it's become harder. Whereas some other capital sources, be that government entities, export banks, development banks, or even credit funds, are willing to take a greater risk on that because they don't necessarily need to feel they need to get paid on time as long as they get paid over time and becomes less stringent. But for traditional bank lenders, it becomes very, very difficult. One way that you can over-engineer these things sometimes, but reserve accounts is something that's been used as well to create some sort of protection against price volatility. But I think and Andrew's captured it there in terms of using the sources and averaging it out. I
And I think
think
also, Rod,
yep.
you
So
mentioned that the cash sweep. I think, that's where I think more and more importance is placed on the cash sweep because it is volatile. You might have periods where actually, the project makes a huge amount of free cash flow, and so paying down debt in the good times can help smooth over the bad times when it invariably hits a dip in the pricing. So, whereas it might be a bit less of a focus on a gold project, particularly given the availability of hedging, but also just more confidence in the forward curve in these critical minerals projects. That cash sweep becomes a really key feature.
yeah, that's right. It's just one more question, Andrew, before we move on, perhaps, which is debt service doesn't cover capex. The way that's captured is in CFADs. So capex would come out in the CFADs definition. So when you look at the cash flow available for debt service, it has already had capex taken out of it. So that's where capex is captured within the ratios.
Yeah, and that's one of the other key ways that CFADs varies from, say, an accounting measure like a net income or like an EBITDA. It truly is just it isn't an accounting measure, but it is a true measure of how much cash is available, and that includes not just operation what we use or we spend on operations or generate through revenue, but what we spend on anything altogether. Any cash that's got to go out is captured that way.
All right.
Andrew, why don't we? Yeah, go ahead.
Thanks, Matt. Look, we've done a lot of work on the model in the first hour of the session. Now, obviously, then when we come into it, it's sort of agreeing the loan terms that are going to apply across the life of the loan. And the parties need to agree how the model is going to translate into obligations and consequences under the project finance loan terms. So we've talked about the financial covenants are obviously a key part of that, and they live in various parts of the project finance loan terms and for differing purposes. So we've talked about the debt sizing ratios. So they're, as we've explained, kind of the minimum ratios to be demonstrated in the model upfront to dictate the maximum debt sizing. So they'll typically assume the debt's fully drawn. They'll be at the most conservative levels of the different ratio requirements in the loan terms that we'll come to in a second. And that's just because it's setting the parameters up front very much on a forecast basis. So by definition needs to be demonstrating a healthy level of compliance to pass muster with bank or other lender credit requirements. As Rod mentioned, it will often include gearing, but this is actually the only place that gearing tends to live in a mining project finance document. It isn't tested through the life of the loan. If it turns out you don't need to draw all your debt to build the project, you don't reset the gearing at completion. It's really used as an upfront test as a general rule. The next place in the finance document package where it becomes ratio is in relation to project completion. So those familiar with project finance will appreciate the significance of project completion. It's effectively the official end of the construction and ramp up phase and the start of steady state operations. But in the loan terms, it typically unlocks a number of restrictions. And one feature of mining project finance, particularly for single asset companies, is that during construction, there will be recourse to the parent company. There's a parent company guarantee that will fall away as a general rule at once project completion occurs. So at that point, the recourse does truly become limited. Construction risk has passed, and it's over to the project to generate the cash flows to repay the debt and be true to the model. Distributions to equity become possible after project completion. They're fully restricted before that test is passed. And in some cases, pricing may even reduce. So the lender's completion test in the project finance document, it'll be a detailed performance testing regime for the mine and the processing plant. But in addition to that technical assessment of performance, there are also minimum financial hurdles that need to be demonstrated. And one of those is in relation to the financial covenants, and that they're forecast to be above certain levels for the balance of the loan life. That is, the model's not forecasting breaches of the covenants once you hit that point. Often the requirement there is that it's actually above the lockup levels, which we'll come to in a second. So you have to rerun the model. By this stage, it will have the actual data from the performance testing of project completion to guide the technical assumptions in the model. And of course, the economic assumptions around commodity price and interest rates and things like that will have changed since the model that was run for financial close. Once we're past project completion, the ratios then are tested periodically, usually quarterly, on the basis of the most recently updated financial model. As we said, from that point, distributions to equity are possible, but only if the ratios are above the lockup levels. And they're the minimum covenant levels to enable distributions to equity. They'll be lower than the debt sizing levels as a general rule, but higher than the default levels, which we'll touch on in a second. If those levels are cleared, then provided the other conditions are met, then free cash flow can be distributed to equity. The next level is the cash sweep ratios. Typically, these are actually the same in terms of the ratio test. It's often the same as the lockup levels of the financial covenants. It's just if it happens 2 quarters in a row, that is often the trigger. And we've talked about the cash sweep. There might be a cash sweep applying at all times. If you're in a lockup cash sweep, that means you're probably taking something more like 100% of free cash flow to repay the debt. You're in lockup, so you can't distribute that cash flow to equity by definition. So the lenders in this period, the fact that it's happened 2 periods in a row, two quarters in a row, suggests potentially a more systemic issue with the project and its gearing levels. So the increased cash sweep there is designed to deleverage the project to a more sustainable level. Finally, the default ratios, as the name suggests, there's a minimum level for the project to clear each quarter to avoid the loan being in default. So these are going to be lower again than obviously the debt sizing ratios, but also lower than the lockup ratios. If you hit these, they're going to give rise to acceleration rights, enforcement rights for the lenders. So we go to the next slide, Matt. That's obviously a drastic outcome for a borrower. And so increasingly, it's become accepted that borrowers should be given the opportunity to address the relevant issue before the lenders are entitled to take enforcement action. And the solution that's typically available to borrowers is an equity cure. So the borrower is given a period of time to procure additional equity being provided to it. So it can be a subscription for shares by the parent company, a shareholder loan from the parent company, which is then used to prepay the project debt. And the amount of equity that's required to be contributed and applied in prepayment is determined from a deemed recalculation of the relevant covenant that's been breached, where the contributed equity is taken into account for the purposes of that recalculation. Now, there's often a negotiation on how that equity will be applied in the recalculation. So for the LLCR and PLCR, if you think back to that, it's the denominator there is simply the debt outstanding. So it's pretty obvious there that if you're prepaying debt, you're reducing the debt outstanding and rerunning the calculation on that basis. For historic DSCR, on the other hand, I mean, that period's already occurred, so you would truly artificially interfering with the recalculation when you do it. And so the question is whether it's applied to increase CFADs, so the numerator, or to reduce debt service in the denominator. And borrowers will prefer the former because it'll be a smaller prepayment. Lenders will prefer the latter because it'll typically require a bigger equity injection and a bigger prepayment. The other points to be resolved with an equity cure include how long a borrower gets to arrange the cure. The borrower is going to argue that it should be proximate to the amount of time it's going to take the parent company to raise additional equity and go through all the various steps. If it is listed, for example, that it needs to do to raise capital. Lenders will say, on the other hand, well, the breach is usually not a surprise. Borrowers should see it coming before the quarterly date comes around and the models rerun. If you've had a bad quarter, you've missed shipments, whatever it is, you're going to know you're in a bit of trouble, and maybe the prudent thing to have done is to have raised equity earlier than that. So the answer is usually at the end of the negotiation, somewhere in between. Um, Another important part for lenders is that there's a limit on the number of times this can be used. What you don't want is every quarter there being a requirement for more equity to come in and cure financial covenant breaches. That suggests, again, there's a systemic issue, and the lenders may want to step in rather than just waiting each quarter to see if equity is there to solve the problem. So often what we see is it's something like 3 or 4 times over the life of the loan you're allowed to do it, and not in consecutive quarters. And really, that last part I think is the important bit, because what it does is it's giving a borrower the ability, if there is something like a force majeure event, something like that causes revenue to have been pushed into a subsequent quarter, for example, and has therefore triggered the DSCR, that it gives an avenue to address that. If it's happening on a consecutive basis, it suggests, well, that shipment should have sweetened the following quarter and we should have had a good quarter the next quarter. Maybe there's something more at issue here. That's the equity cure. And that's kind of how the financial covenants play through the loan documents. Another feature in terms of bringing the model to life in the loan document is the cash flow waterfall. Now, the model, as we've touched on, is obviously all about cash flow. What the waterfall does is it tries to effectively recreate the model in a practical way, once the project is in operation. So there's a single account, often called the proceeds account. All project revenues are required to be deposited in that single bank account. So it sort of becomes a proxy for revenue being earned by the project from all sources. So that could be from the sale of product, could be from insurance proceeds, hedging receivables, whatever the source of the income, it's all going into that proceeds account. Then withdrawals from that account are regulated through what we call the cash flow waterfall, which is effectively just a mandated order of payments from that account. You can see there in the slide. So we start with operating costs. Now, lenders definitely want operating costs to be paid so the mine can keep running and generating revenue. Tax, has to be paid, so it will be paid at the top of the waterfall as well. Sustaining CapEx, again, to make sure that the project can keep running and delivering at the levels that are anticipated to generate the revenue. Then we hit debt service, as we've discussed earlier. The debt service reserve account is a common feature where cash flows need to top up a reserve account, which is typically covering the next 3 or 6 months of debt service in the event there is a shortfall in revenue. The cash sweeps then tend to come out at that point, and finally, we get to free cash flow. So the free cash flow, if it's available, that can be retained by the company to build liquidity, can be used to voluntarily prepay debt. Or if the lockup ratios are hit, as we were describing earlier, then it can be available as a distribution to equity. So the whole idea of this waterfall is, as I said, to try and recreate the model as much as possible. Now, ideally, payments, or in a perfect world, to reflect the model, every single payment would be on each quarterly date. And so what we try to do is push as many things to the quarterly date as possible. So typically interest and principal payments will happen on the last day of the quarter, the DSRA top-up obligation, the cash sweep obligations, all sort of reference that quarterly date. Obviously, OPEX and tax and sustaining CapEx, they're costs that need to be paid when they're paid. So it's not perfect, but it does the best job that we can to recreate it in the model, and does sort of present a nice logic in the legal documents to match the financial model. So the
And if I
last
might
bit,
interject there, just
no
Andrew,
problem.
this is again, I think this is a really good example from a lender's perspective where, the individual banker really has to be across what's in the document and what's in the model, because typically it's the banker that's bridging the two. As you said in before, Andrew, when we've spoken, you don't necessarily get to see the model,
Mm.
so it that can create some challenges in terms of making sure everything aligns. But that's a critical point.
Yep.
Sorry, you've got one
Yeah,
more. One
yeah,
more
yeah.
Yes.
What was going to
slide
jump in
to
as
move
well,
on to.
Andrew, just to say, and we'll look at some more of this in a couple minutes. But as you see, this is something you certainly want to make sure that your cash flow waterfall and your financial model is matching what Andrew's describing, right, in the documents, and that what is included before, here we call it CADs with CFADs, is in your model is matching what's deducted before CFADs in the contracts as well. Because if you've got something above the line in your model and below the line in your contracts, well, then you're probably shorting yourself on your CFADs and raising less debt than you could. And other way around, you've got a problem where you're not actually going to have as much CFADs already before anything else varies from what you expected to pay your debt service.
Yeah. Yeah. Thanks, Matt. Okay. I just noticed there's a question in the chat about the typical cash sweep percentage levels for project finance. I mean, I do think it is commodity specific and project specific. Sometimes there is no hard and fast cash sweep. It's just a cash share, as Rod said. If you want to distribute to equity, you've got to share a portion. In others, it'll be, as I said, for critical minerals projects, we usually see there is just a standing sweep if there is excess cash flow. So, and then those percentages are often negotiated positions and very much sort of dependent on the model in question and the project in question. All right, I'll go to the last slide, Matt, in my part. So we've talked a lot about the model, um, what it does, how it translates. One thing we also know is that the inputs in the model are going to change over time. So the model that we've used for financial close, which gave us the debt sizing parameters and set all those things up front, that's clearly going to need updating over time. So when we hit completion and we've finished construction, we now have a better idea of how the project's operating. We also have a different macroeconomic environment that the project will be operating in. So the parties need to agree a regime for how often that needs to occur, including when it first occurs, for periodic updates, what other events should trigger a requirement to update the model, who's responsible for preparing it, what needs to be updated, who has the final say if the parties don't agree. So there's a bit of wood to chop there and is typically another point of negotiation. The update triggers will be a mixture of regular interval updates and event-driven updates. One common reservation from borrowers that we hear in negotiation a lot is that model updates take a lot of time, a lot of management time, and they also will. We need to be focused on the project and making sure it's going well. We don't need to be updating the model every second week. That's distracting us from the business at hand. So it does need to strike a balance between the period of time before the model is clearly not keeping up with reality, while also not revisiting it more than is necessary. So that'll be the driver of the kind of the regular intervals and how regular they are. There are also usually one-off events that'll require a model update where lenders will require that. So major changes in assumptions, whether they're technical or economic. And we'll touch on that in a second. For certain commodities, entry into an offtake agreement. We've talked about the different pricing sort of factors for different commodities, and if there's a fixed price or floor price or something like that in a commodity that doesn't otherwise have hedging available to it, or a really accepted forward curve, that might be something where it requires an update to the model. Changes to the mine plan, which Rod talked about, that are going to shift the revenue profile of the project. All things like that will typically, if it's material enough, and there'll be debates about materiality, that are going to trigger a requirement to update the model. The main points for updating are the inputs. So we're not actually messing with the beautiful Excel spreadsheet that Matt's produced and the sort of the infrastructure of that document. For the most part, we're talking about the actual data that goes into that. So for the DSCR as a historic test, it's obviously a matter of inputting the actual data based on the relevant testing period that's just occurred. For the forecast ratios, it's about updating the assumptions. So you can see there we've got up this the split between economic and technical assumptions. That's generally the grouping we think about it in, and once we get to this process. Economic assumptions, things like commodity price, FX, interest rate, tax. I mean, a lot of those will have, particularly for as we've talked about, commodities that have reference points like Bloomberg, LME, that kind of thing. That you will actually agree up front. Well, that's what we go to when we're updating the model. You just get the forward curve for those, and you put that through the model as it now stands. The technical assumptions, things like grade, recovery, and mine life. The borrower will typically have the best view on that, but what the lenders will want is some sort of independent verification on that. So that's where the lenders will often have an independent technical expert who will sort of be giving advice on changes to the lenders, whether they're reasonable, whether they're agreed or not. So once it's updated on those bases, generally the lenders need to approve it. Like before it becomes the model on which all the things are tested that we've talked about, it needs to get signed off by the lenders. So if you're a borrower, you want to understand the basis for any non-approval, and borrowers will often push for the right to refer matters of disagreement to an independent expert, so it's not a sort of final veto right from the lenders, but that obviously comes at a cost and time, so it's not always the case. But as you can see, it's not necessarily a slam dunk how all this just comes together in the loan doc. There's plenty of room for discussion and always is. But I'll hand back to you now, Matt, to bring all that together.
Thanks, Andrew. Before we just jump through maybe a conclusion around the model and tying this all together, a couple of questions that have come through. One around PF and mining loan facilities, whether or not they typically are going to have all three financial covenants, or maybe even more than that. We've talked about around LLCR, PLCR, gearing, DSCR, or key considerations, and maybe one of you might best place. I know from my own experience, it really does depend on the industry, and mining in particular relies on probably all of these in my experience. But I don't know if you've ever seen anything different.
Well, I think as Andrew said on the gearing, it's more of an opening requirement, more of a condition precedent to first draw. I think when you look at a real junior greenfield startup, especially probably emerging markets, then you're probably going to have all the bells and whistles. You'll have a bit of everything in there. If a company is larger, if it's more established, but perhaps still a non-recourse loan, then borrowers can push to reduce the amount of covenants that are involved. And in an extreme case where you've got an asset which is non-recourse, so we're sort of moving away from project finance here, but it's still non-recourse. We've even seen situations where you still use the debt sizing metrics we've talked about in terms of project finance, but the covenants are actually more semi corporate in nature, almost like an EBITDA with a capex adjustment or things like this. So sometimes it can actually be quite a broad-based approach.
The other thing added there is, the other, the reserve tail ratio is actually, for a lot of mining projects, is a really important one and does continue to be tested through the life of the loan. It's really just for projects like, some commodities where the loan life is actually huge. It's not actually, mineral sands, some of the critical minerals, they often have really long loan life, so that actually the issue is not reserve tail, it's just how quickly can you actually generate enough cash flow. You don't often have the sort of sugar hit to cash flow that you get with, say, a gold project. It can be a slower burn, lower quarter to quarter cash flows. So because debt as a general rule has a tenor, particularly commercial bank or private credit debt will have a tenor limit, and that's another reason why you see ECAs and government finance institutions playing a bigger part there, is because they can do 15-year debt, that kind of thing, what they can do is crowd in private sources of capital who can take the early periods of amortization, and then you actually get to the government lenders in the later periods who have sat there patiently. And because they are there on a policy basis as much as a commercial basis, they're willing to sit and wait for longer, and that's a way of dealing with that spread on the revenue profile.
Thanks. And why don't we'll hold on those last two just to make sure we get through the last bit here, and should have a few minutes still left for some more Q&A at the very end. So if we haven't had your question answered, just hang in there. We should have a couple extra minutes. Want to close sort of talking about the model and bring this back around to the idea of a financial model and why it's important for these transactions. It's probably becoming clear in a lot of cases, right? We're talking about a lot of different forecasts, a lot of different ratios that need to be used to size that need to be used to track the project over time and make sure that the project is in compliance with any covenants and anything else under its loan agreements. We're talking about things that would be quite difficult to do with paper and pencil, right? Wonder how anyone did any of this stuff before we had the wonderful tools that we have today. But when we think about a cash flow model, right? When we think about a project finance model, the key thing to keep in mind here is we're trying to align the expectations of a lot of parties, right? Certainly debt and equity, but also maybe could be multiple lenders, could be multiple equity investors. Anybody who has an economic stake in the project needs to be able to understand what they can expect their cash flows that they'll receive to be over time, because the amount of cash flows that they'll get in the future, or they can expect to receive in the future, is going to directly impact what they're willing to invest in the project today. I said earlier that at a simple level, at least to start with, debt sizing is often just a present value of future cash flows to the lender. Well, that's going to apply to all different investors. Would you be willing to invest, or how much will you invest, or would you be willing to invest the amount that you'll need to based on how much debt you can raise? Your model is going to help you understand that. Really critically, a well-built model can help us quantify risks, right? What are the risks that really matter? Whether it's a delay to the project, whether it's variations in operational metrics or commodity pricing or anything else from what we had in our base case, what things are really going to hurt, which things are not going to hurt so much, and how much will each one be, and which ones should we be really focused on? And especially when lenders are thinking about downside scenarios, which ones are they most concerned about? They're going to need a model to help understand that. Those ratios we've talked about quite a bit, using them to size debt in the first instance, possibly sculpt repayments, and then monitor performance over time. Certainly we want to show our returns, but more broadly than that, we want to be able to present outputs for decision making. The model itself is not the end goal, right? The model is a tool for decision making and a tool for telling a story about your project and presenting that project. And if you've built the model, the work you've done in the best possible light. So the creation of the model is not an end goal in and of itself, but it helps to make decisions about how much we'll invest or whether or not we're willing to invest in a new project. And really critically, and we'll see this in a minute, models need to be flexible enough to compare upside and especially downside scenarios. The only thing that we know is true of every single financial model is that it is wrong. From day one of development or investment or operation, the actual numbers are going to be different from what you had in your model. You'll never be able to predict exactly what will happen, but you need to be able to understand what reasonable downsides are and whether or not those would put the project at risk given a certain debt size or any other metric. As you can imagine, these things can get pretty big and complex, especially when we're talking about all of the different metrics and all of the different inputs and calculations we've been talking about here today. They can get really difficult to understand. And if you're not careful building these models, they can get to a point where they're almost impossible to update and manage. And so using best practices can help to create models that are easy to read, easy to understand, and easy to share with parties that need to decide how much or whether or not they're going to invest in your party. Because the greatest, most correct, whatever that means, model in the world isn't very useful if someone else can't open it up and understand what they're reading and understand the value and the risks of the project. So we like to keep in mind a number of different best practices to make things clear and easy to read and also least likely to end up full of errors. For mining in particular, a number of things we need to make sure that a model can do. First of all, we want to be really clear and separate various parts of our model. We don't want to have inputs, hard-coded numbers floating around all over the model in with the calculations and mixed in with our outputs and have inputs and outputs in the same place. We want to be really clear about how information goes into the model, where it goes in, what cells a user should change and which ones they shouldn't, and then how the calculations flow through the model from beginning to end, and then where we display our outputs, keeping them all in one simple location. So if I pull back up again really quickly, that model that I had quickly shown the cash flow waterfall, and this is actually the ending model from Pivotal 180's online mining and critical minerals project finance course. So if you go through that course, this would be what you would create over the course of that program. You see this pretty clearly. We've got an input sheet where we keep all of the inputs for the model. In fact, all of these yellow cells you see are cells that a user should change or can change. If you go into any of them, you'll see there's a value in any of those cells, right? These blue cells indicating that these are formulas here. We don't want somebody to come in and change these cells themselves, because if you don't do that, if you can't tell whether or not this is a hard code or a formula, same with this one, how can anybody understand what cells it's safe to change and which ones they shouldn't change? From the inputs, we then flow information through our operating sheet, calculate all of our revenues and our operating expenditures, all the way down to cash flows. Cash flows, which are basically the end result of our operating section of our model, then flow into funding. They go into the cash flow waterfall, and the result of the cash flow waterfall eventually go through our sizing and sculpting of debt, including our calculation of all those ratios that we talked about before. LLCR, PLCR, reserve life cover ratio. We have a maximum gearing constraint further up in the model as well. So very clearly flowing from inputs through to operational calculations, our funding calculations, and then place we didn't spend a lot of time, but where it can be relevant, especially as tax impacts things, into our depreciation and tax sheet as well. Won't go into in detail. And then we don't rely on users of the model scrolling to the very bottom of each sheet to find out, hey, what's the debt size or what's the IRR or whatever it is. We've got nice dashboards to display these things, right? People don't want to look at things. Yeah, we may need a quarterly model. It's going to be important, especially if we've got quarterly debt service, but let's look at things on an annual basis. Let's make things a little bit simpler for the users of the model, and especially the key decision makers to see and understand. We'll have our 3 statements, cash flow, got our debt metrics, hopefully some nice charts and graphs showing things like CADs versus total debt service, how the loan is paid down over time. We've got some of our metrics and ratios built in here as well, like the reserve tail ratio, overlaying these things on top of each other and relating the reserve life to the loan life, cash flows, and debt service helps to visually make an impact and make it easier to make sort of high-level decisions about how to size and structure these sorts of facilities. A lot of things to keep in mind here, and staring at 10 million numbers doesn't make anyone's life any easier. So while the calculations to lead up to these are important, these sorts of tools really, really useful as well for seeing things at a glance. And these are the kind of things you might need to include in, say, an investment committee paper when going to make a decision about financing. Lastly, said it was really key to be able to have that flexibility to run scenarios and sensitivities on any number of different things. What you'll see in this Pivotal 180 model is that we've got a base case, as Andrew talked about. What's the base case? Probably equity's view of what they expect to happen with the project. Probably a lot rosier, perhaps, than the lender's case. Lenders want to make sure they're getting repaid and probably having more conservative views on, say, commodity price forecasts, maybe other things as well. But then we're going to need other scenarios as well, right? What happens if the level of production is less than expected, or if the grade of recovery is lower than expected? What happens if our operating costs are higher than expected? Spot prices are lower. What if any number of those combined happen? We need to be able to run cash flows on an equity case as well as on a lender case and size debt on a lender case, and then be able to stress test those things and say, hey, once I've sized debt, what happens if any number or multiple of those sensitivities that Rod talked about come to pass? Some of you may have noticed there's a big red check going off at the top of the model, something that can be a little bit scary, but nice to see anytime it does. Why is this happening? Well, in this model right now, we've sized debt based off of a lender case. We've got a data table at the bottom showing us the result of multiple cases, another great tool to have in your model. And then we're seeing, it turns out that when we run our grade downside case and our OPEX downside case and our spot price downside case, we're actually breaching some of our covenants. And as a user, I can then go in and say, okay, I've got to massage this sizing a little bit or massage some of my inputs in order to get this to a point where this debt size is sustainable, or perhaps it's not, and I need to reduce the debt size to account for those. As Rod said, maybe more art than science. And sometimes you might be able to automate some of these things with macros. Often it can become circular, and often it's more of a case of experience and understanding where things are going wrong and being able to adjust numbers for that. Lastly, and then I'll give it 1 or 2 minutes perhaps for a couple more questions. Key takeaways from today, right? Non-recourse project finance transactions, lenders are looking for certainty in cash flows to reduce their risk to debt. As Rod said, lenders like to get repaid, and they like to get repaid on time. They need to have that certainty of cash flows, and the best way to do that is through a good financial model, and then they can protect themselves against downsides with a number of terms as he discussed. Gearing, right? We want to raise debt because it increases equity's return on investment, but lenders need to adjust for cash flow risk specific to mining with increased ratios like DSCR, PLCR, RLCR relative to other industries, conservative commodity price forecasts, those additional ratio tests I mentioned, cash sweeps and shares, debt service reserve account, increased requirements there, as Andrew touched on a couple of minutes ago, possibly some required hedging, although there's a balance there as well. More risk in general is always going to mean less debt, whether that's because of higher ratios, higher interest rate, conservative price forecast. More risk is going to mean less debt. We can still use a model to optimize our project and raise as much as we can. Might be able to reduce risk via hedges and other forward contracts, though as Rod mentioned, there can be some limits to that. And clear, flexible, best practice financial models that match what's in your contracts, really critically, are going to be essential to gain lender confidence and execute successful financing. For those that can stick around, happy to answer the rest of these questions. Thank you very much, everyone, for joining. Thank you so much to Rod and to Andrew for joining today as well. Really hope you've enjoyed it. As I mentioned, the video of this session will be available within a couple of days. We will send out an email once that is all available. Feel free to share with your friends and colleagues. And if you'd like to refresh on any of this, come back to this. This will be your source for the slides as well. Thanks everyone for joining. Again, for those who would like, if you want to stick around to answer questions, we'll do that. But otherwise, have a great rest of your Monday. So Rod and Andrew, if you do have a couple minutes, a couple other questions that had come up. One was around interest rates for mining projects and how they compare to other industries. Do some of these protections help mitigate what might otherwise be looked at as a less investment grade rated sort of structure?
Well, there's a couple of points here. So first of all, um, interest rates on average would probably be higher for the reasons you mentioned. If we, on the one hand, you might be comparing a multi-billion-dollar power project to a $200 million emerging market gold project or something. So naturally, the interest rates are going to be higher for that, and because of the risk associated with it. That said, depending on the project, there could be cross-sell available to lenders, most notably hedging. And as a result of that, lenders will often look at the total return that they're getting for the risk. And if there's reasonable amounts of hedging and there's income coming from that, then they will probably be sharper when it comes to the interest rate. What we typically find is that the interest rate on a mining project will be less than what it would be if you were to say, this is a B plus credit trading in the marketplace, and that would be the price of that debt. And that comes back to relationship reasons. It comes back to comfort through legal structure, security, and it comes back to what other cross-sell or relationship benefits there may be. As it relates to investment grade, I mean, sometimes it's curious. I mean, you can see prices that are almost priced at interest rates at investment grade, even though the underlying project clearly isn't. But that could be, again, a function of what other cross-sell is available to lenders to earn from the relationship. And so the loan is essentially cross-subsidizing those other revenue streams. But it's quite rare that a small or medium-sized project would actually reach investment grade for all the reasons. It's not big enough, there's too much price volatility and so on. It has to be a very sizable project to start getting into the investment grade world. I don't know if there's any comments, Andrew, you'd add to that.
No, I think that's more your bailiwick, Rod, so I agree with all that.
Yeah.
Thanks,
I
Rod.
can maybe
Maybe one more, and then I know people have to go. But I think practically the question around is there one model agreed between all the lenders and the miner, or could each lender have its own model? I know in my experience we do have to agree on something if we've got a consortium of lenders. Have you ever seen, Andrew or Rod, where we have a disagreement on the model and lenders providing loans on different sets of assumptions?
I've certainly never seen it. It kind of, thinking about how that would then play through if the lenders are on, from a legal perspective, if the lenders are all part of the same, effectively the same loan. Now
Yeah.
they might not even be all in the same loan agreement, but they might be tied by some sort of common terms, but effectively lending to the same project. I think if you're the borrower, you're going to want as you're going to want one model, one source of truth, because that's sort of making my head explode, the thought of there being multiple models across the financing.
Yeah, no, I totally agree.
Yeah.
I mean, the one thing is, though, lenders will be presenting most likely different scenarios to their credit departments internally. That maybe they have to use the in-house commodity base case. Perhaps they have different sensitivities. They all have to ensure that it gets to the same place, which is a credit approval. Um, and it may also be the case that lenders use the agreed model but have some additional outputs. We certainly need to do that for regulatory purposes. There'll be extra sheets that we add internally just to be able to produce metrics that need to be seen. But those won't necessarily be part of the official legal agreed upon base case model.
Right. I think the entire lender group has to at least agree on the terms and the structuring there, and then make sure it meets their own internal requirements. Otherwise, they simply won't be part of that lender consortium. I know there are a few other questions, but I want to be respectful of everyone's time, and especially Rod and Andrew. So thanks everyone for joining. I have noted down those questions that were still outstanding. If you had your name on them, we'll do our best to get back to you via email, or if you had them anonymously, please feel free to reach out, as I mentioned, to me via email, and we'll try to get back to you separately. But with that, thanks again, everyone, for joining, and look forward to your comments, your questions, and seeing you hopefully again on another session.